We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today are two guests, Ole Adler from Ole Adler's Liquidity Trader, the Wall Street Examiner, and host of the CapitalStool.com message board, as well as Bob Coleman from Idaho Armored Vaults. Thanks for joining me today, guys.
Thanks, Tom.
Hi, Tom. Thanks.
So this is a bit of a special episode. It's been a while since we've had an update from Lee, and Bob seems to read a lot of his stuff, and it seems that Lee has been really on top of all of the Fed movements, and with some of the indicators that he looks at, it really gives us a good sense of what's going on in the markets here. So I want to thank you both for joining me today. So maybe we could start, Lee, by asking what macro liquidity is and why it's so important to be watching at the moment.
Well, I call it macro liquidity. It starts with the Fed and the former QE, the money that it was pumping into the system day after day, week after week, month after month for 12 years. And since then, they've gone in reverse with that until a couple of weeks ago. There are other measures that are also important, a little bit less important than the Fed, but in order to keep track of them, I track the level of deposits in the commercial banking system in the U.S. That's a weekly statistic that the Fed publishes with about a 9-day lag. Of course, it publishes what's known as the H41, which is the weekly Fed balance sheet. And that is virtually real time. That's from the day before. So on Thursday evening, they publish their balance sheet status as of Wednesday. So we have that pretty much in real time. I look at the foreign central bank holdings, custodial holdings at the Fed. I look at the banks' holdings of treasuries, because when they're buying treasuries, that obviously pumps liquidity into the system, and they can create liquidity by lending against that. So there are several inputs that I use for what I call my composite liquidity indicator. And I've seen over the years of tracking that since, last 12, 15 years, that stock prices tend to move in a band along the direction of this composite liquidity. There's a particularly tight correlation with Fed assets, with the Fed system open market account. There's a very tight correlation with the level of deposits. The Fed was kind enough until a year ago to publish the unrealized losses on the bank balance sheets, but that got to be such a horrendous thing dropping off the bottom of the chart that they stopped publishing that about a year ago. So we have to wait for the quarterly releases from the FDIC. And about a month ago, when they released from the first quarter, and they said, wow, everybody, look at this. Look how much the unrealized losses on the bank balance sheets are. People started to put two and two together. Well, my readers have been aware of this for a year and a half because we've been tracking it. Mm-hmm. But so I guess that's what I do best. That's to keep an eye on things that nobody else is watching, but are extremely important because they correlate, if not cause, exactly what we're seeing today. So, I look at all these banking indicators. I look at the Fed. I look at the level of withholding taxes, which is published daily in real time by the U.S. Treasury to give us a handle on what the economy is actually doing, not what the data says it's doing, but what the taxes actually tell us it really is doing. So I'm looking at real data. I'm trying to track it closely. Before this crisis erupted a couple of weeks ago, we always knew what was coming because the Fed would tell us. It'd say, here's the policy, we're going to do this. And we could match that up with what we knew the Treasury supply was going to be. We knew what was coming, but suddenly we don't know anymore because we don't know, we know the Fed is going to have these emergency knee-jerk reactions. We don't know when they're going to be needed. We know they're probably going to be needed again. Are they going to react with the same force that they did a couple of weeks ago? We don't know. The Fed doesn't know. Nobody knows now. So the issue now is for me is to really keep a close eye on the weekly data and to keep an eye out for anything that changes that might raise our antenna a little bit that this could impact the stock market and the bond market and gold.
Mhm. Yeah, and it seems like, I want to go back to something that you said there was that QE ended just a couple weeks ago. And
No,
is that
no? QE ended a year ago.
Mhm.
Quantitative easing ended a year
Yep.
ago. Quantitative tightening has been underway since March, April of last year. The fact that we knew what was coming, that ended 2 weeks ago, because now the Fed is completely in reactive mode. They are running around with their hair on fire and they don't know what to do. So now there's no policy anymore. It's just knee-jerk reaction. And they've admitted as much as they say we're totally data dependent now. So now we're back to the 70s. We don't know what the Fed's going to do next. So that's the difference. It's having a known schedule, both from the demand side, which is the money creation side, which is the support for demand, the fuel for demand, and from the supply side, which is the U.S. Treasury constantly adding supply to the market. So now we only know half of that equation, which is the supply side. The demand side, we don't know how much they're going to fund and where they're going to fund it and what they're going to do. So we got to watch the data. Mm-hmm. And the good news is that markets move on the money movement. They don't really anticipate very well. So we don't really need to be ahead of the game and try to guess what they're going to do, because that's a fool's errand.
Right. Thanks for clarifying that, Lee. So, the last time you and I spoke, we talked about QE and how it works. And I think this would be a good time to, let's say, understand how the Fed and the Treasury stepped in to back the bank deposits of SVB and the others. And is that a form of QE like some have suggested?
No, it's completely different. Mm-hmm. When the Fed was doing QE, it was pumping money directly into the market at a fixed stream of 100 or 200 billion a month, except in the pandemic emergency and a couple of other emergencies where they boosted it. And that money went directly into the market because the conduit was the permanent open market operation, which is essentially a trade with a primary dealer. They bought bonds, they bought treasuries and MBS from primary dealers. So the money was paid directly to the dealers, and then the dealers could do what they wanted with that cash, including, of course, buy more treasuries. So the price of treasuries kept going up and yields kept going down. And then at the margin, they would buy stocks. So the price of stocks kept going up. And we've seen the correlation charts many times. Now with QT, it was sort of the reverse of that. And, we saw a kind of a bear market, if you want to call it that. I don't like to get hung up on semantics too much. But the quantitative tightening did not work through direct permanent open market operations. It worked through allowing the Treasury holdings of the Fed. The Fed would allow its holdings to mature, and it would say to the Treasury, pay me back now. I want my money back. So the Treasury now has to pay back the Fed for the $60 billion a month in its holdings that the Fed was just allowing to mature and roll off. So the Treasury's now got to go into the market and raise $60 billion a month, so to pay back the Fed. So when it sells new debt, that extra $60 billion a month to, Joe Sixpack, or the money market fund that holds his money, or really the customers are the big institutions. When it sells that debt, those institutions then make withdrawals from their bank accounts to pay the Treasury for the new debt. So bank deposits shrink. And everybody's surprised at how bank deposits have been shrinking in the last year. Well, this was predictable. And in fact, we predicted it because we knew how the mechanics of the program would work. It was going to pull money out of the banking system. And when the banking system, when the deposits contract, there's less money to buy bonds. There's less money to buy stocks. and the price of everything falls and the yields go up. And we had a horrible bear market in bonds. Now there's things that work in the opposite direction. Okay, now, so we have QT sucking money out of the system at $60 billion a month, but suddenly there's an emergency because as the bond prices fell, banks are underwater with their portfolios, with their bond portfolios. They've lost a lot of money, but the legalities of it say you don't have to recognize those losses unless you're forced to sell. And this is another thing that we were able to predict, that as the losses accrued, they would be, and they had to continue buying the $60 billion a month in new debt. There would be the time would come when they would start to have to recognize the losses. Now, I never thought there'd be a bank run. I should have, but the bank run started, and then SVB and this other bank were forced to sell their treasuries at a loss, and everybody realized, oh my God, these guys are insolvent, and they had to shut them down overnight. Well, guess what? They're not the only ones that are insolvent, but the rest of the dead bodies will only float to the surface again when there's another bank run. So now what does the Fed and the FDIC and the Treasury do? Well, they print a hell of a lot of money, but that money that they're printing, they're not transferring into the primary dealer accounts for them to buy stocks and bonds. That's going to the depositors. They're using that money, that $300 billion that they raised, that they injected as loans, okay, not as direct purchases, but as loans, emergency loans. They injected that money into these banks so that the depositors could get paid their withdrawals. Mm-hmm. Now, what did the depositors that were running on those banks, what did they do with those withdrawals? They put the money into government money market funds. All right. So it didn't go into the market. It did. Now we're seeing some of it go into the Treasury market and filter out the curve a little bit. It's rippling out the curve. But for the most part, it went into the money market funds. So we saw that data 2 weeks ago from the ICI. They tell us every week what is the level of money market funds, institutional and retail. So it's different. And there is, the cash is out there. It can be used to buy stocks and bonds, but the rallies right now are about something else. They're not about that. So no, the money from these emergency loan programs is nothing like quantitative easing. It doesn't work the same, doesn't have the same effect, doesn't have the same purpose. And will it ultimately come around back into the market? It could, but I don't think for long. And I think that we have another crisis looming sooner or later.
Mm-hmm. Yeah, I spoke to another guest yesterday, and he said the Fed is playing whack-a-mole right now with the problems that they're going to have.
Yeah.
So you mentioned that you look at a lot of this data in real time instead of with a lag. Have you seen a slowdown in the velocity of bank runs that stemmed from that last bank collapse?
I don't understand the question. The velocity of bank runs. In other words, the shrinkage of deposits. Mm-hmm. The data that we just got on Friday was from 9 days before that. So this huge collapse in deposits we already knew it happened because it was from those initial runs. So what happened in the last 7 or 8 or 9 days, we don't know yet. Now, this afternoon or tomorrow, the ICI will give us the money fund data. So this will be a heads up. If we see another big surge in money market funds, then we know that there's somebody's hemorrhaging. But if the money market funds kind of stabilize, or if there are some withdrawals, then maybe the situation is stabilizing and everything will go quiet again for a few months. So that's a big key right now, to watch out for the ICI data that gets released tonight on the money market fund levels.
And you also mentioned that nobody really realized which banks had issues like this until they had to start, or until the bank run developed. So is there any way to tell where, another one of these problems might present itself? As you said, the dead bodies will float to the surface.
I don't know, because I'm not a bank analyst and I don't follow the individual banks. I mean, there are people out there that track this data and track the individual bank balance sheets and have a better handle on which banks are the most at risk. I don't. And, I wish I had the time to do that, because they would be the best shorts. Mm-hmm. Obviously, some of these banks are clearly not doing a good job of managing this situation, and others are probably in pretty good shape. But I would think that most of the primary dealer banks are so well plugged in that they're probably managing pretty well. And I've seen that in tracking the primary dealer data that comes from the New York Fed. We know how much they're holding in bonds. We know how much financing they're doing. We know how much hedging they're doing in the futures market. And so they've kind of done some repair, but they were positioned largely wrong, a year and a half ago. So there's risk out there, but I don't know specifically who the next bodies to float to the surface are going to be, because I'm a macro guy, not micro. So, but there are people out there, you can find them.
So are bank deposits all about confidence, Lee?
Yeah, and most of us are able to handle the FDIC deposit limits. I mean, if you have more than $250,000, you could do like Giannis Antetokounmpo, who put his money in 50 different banks, and had 50 different insured deposit accounts. Government money market funds are another alternative, and most of the money market funds are almost all in governments now. So people, the big money people that don't have this deposit insurance, they're the ones that maybe are starting to pay attention now to what their banks are invested in, what is backing their deposits, and is the money really there? But how much of a haircut are they really going to take if the FDIC or if the Treasury or if the Fed doesn't stand behind these deposits? I'm not sure it's a situation that's going to break the system. I mean, maybe it'll be a 20% haircut, 15% in some cases, but that's probably a worst case scenario. But of course, when you have billions, you don't want to lose hundreds of millions. Yes, it's a confidence game for the big money people, but for smaller depositors, I don't think anybody's really that worried. And they're not going to move the system anyway.
Mm-hmm. So I'd like to drill into let's say the relationship between deposits and stocks a little more. If you could explain that to us a bit more, how deposits coming out affects stocks.
Well, okay. When you buy a stock, where does the money come from?
From let's say my checking account.
Yeah. And when you sell a stock, where does it go?
Back to my checking account.
Okay. But does it, the other guy on the other side of the trade, what happens to him? His money. Same thing. It's just going in the opposite direction, right? Mm-hmm. So the money never leaves the system. Okay. So stock trading does not impact the level of deposits one iota. On the other hand, when the Fed is pulling money out of the system, there is less money in the aggregate of all of the deposits. There's less money now available in the system to absorb new supply. Now, there's really only one 700-pound gorilla of supply, and that's the U.S. Treasury, which is constantly pounding the market month after month, with the exception of April and the other quarterly months, that they're pounding the market with new supply. The market has to absorb that Treasury supply, and that competes with stocks and every other asset class. And banks buy Treasuries in order to back deposits, especially when they're not lending. So when there is less money around and there's another wave of Treasury supply, so the holders or the buyers of the new Treasuries have to liquidate something. They either liquidate existing bonds that they hold, or they liquidate stocks. So that in general, there is a very strong correlation with falling deposits and falling asset prices. In the last couple of weeks, that correlation has broken. So we have this huge divergence. My bet would be that it has to come back together. Is it going to come back together by deposits surging? I don't think so. It'll come back together because deposits have been trending down for a year now. This is not new. The drop-off that happened last week was still within the trend. It was right in line in the trend. So I think that the prices of assets, stocks and bonds, are going to come back in line. Not in April, maybe not in the beginning of May, but sell in May and go away towards the end, maybe June.
And Lee, why is it that the Treasury has that effect in April?
Well, because Americans pay their taxes in April. So, and this is a seasonal effect that's been going on forever. Why is April always so strong? Because in April, the U.S. Treasury receives an enormous influx of revenue, hundreds of billions of dollars, way above what it normally receives in the other 11 months. So what it does is it takes that big windfall that it receives and it pays down T-bills every year, like clockwork. And the money has already started to flow in. And just this week, the U.S. Treasury is paying down $55 billion in outstanding expiring Treasury bills. Now, most of those Treasury bills are held by money market funds or wealthy individuals, some businesses. So what happens is, they have interest-bearing Treasury bills that suddenly they're getting their cash back. So $55 billion in cash is coming into the market this week. What are they going to do with it? They can't buy more T-bills. So some of it flows into the Fed's RRP, reverse repo slush fund. Mm-hmm. And some of it at the margin is used to buy assets that are reasonably stable and seen as a good place to park. So, money has been kind of rippling out the bond curve towards the longer maturities. We've seen a huge rally in the bond market the last few days and weeks because these paydowns get underway, and there will be more throughout April. So there's going to be a huge, huge wave of cash that flows into the market in April. So it would take something pretty horrible to reverse the effects of that. And, I think that we'll see a pretty normal, stable to rising asset price situation. I think people are obviously starting to look at gold as an alternative to risk assets and bank accounts. And, gold is really on the verge of an epic breakout through that 2080 level. I think it's a given. I think it's a foregone conclusion that that's going to happen.
Mm-hmm. Well, maybe before we get to gold, you mentioned the reverse repo program, and I've seen that the volume and the amount is up fairly significantly. Do you see any issue with that, or have a lot of those issues been dealt with since that the problem that we saw in 2019?
The Fed created the reverse repo program to give the money market funds a place to put their excess cash when there was a shortage of T-bills, because that's what they invested. And when they pumped all that money into the system, there was a lot of excess cash. So we saw during the pandemic in particular tremendous growth in the reverse repo fund. It really has been completely stable in the last year. It hasn't changed. It's in a range. It's at the top end of the range now. And of course, you have the quarterly window dressing. So on Friday, March 31st, it went up to 2.319 trillion, which I'm not sure was a record. If it was just a record by a hair. But then on Monday, it dropped down by 250 billion again. So, they're playing games that way. But it's in the same range. Okay, it hasn't grown at all, hasn't shrank at all. So the 90% of the holders are money market funds, government money market funds. And the reason they have to go into the RRPs is because there are fewer T-bills for them to invest in when the Treasury does paydowns. So that's part of the reason for the rise in the last couple of weeks. The other reason is, again, you had a bank run. A couple $100 billion in cash was transferred into these money market funds. Where did they go? There were no T-bills for them to buy, so they would, they're perfectly happy to hand it over to the Fed overnight and get paid interest on it, which is a huge scam, but that's how it works. So the RRPs are an effect of this excess money running around, and it will dissipate when the the debt ceiling is lifted ultimately in a couple months, and the Treasury has to start refunding all the stuff it's borrowed against. So it's going to start issuing Treasury bills again, and that will start pulling a little bit of money out of the reverse repo, what I call a slush fund. But unless we see that fund kind of intrinsically declining on its own for no apparent reason, it's not bullish. The more money that sits there, the less bullish it is. It's basically bearish. It's people avoiding risk. It's all of the holders of the money market funds being perfectly content to sit with their money market funds from now until kingdom come.
How could intervention by the Fed in that reverse repo facility affect interest rates?
Well, let's say if we get into a crash in the markets and the Fed decides it has to do something, it could limit the size of the reverse repos operations. And that would force the money back into the banking system, and it would force these holders, these money market funds, and at the margin, there's some banks, there's some investors at the margin holding this cash. And of course, the holders of money market funds are also investors. So the object would be to force them to decide to buy some financial assets, stocks, bonds. So that the Fed could lower interest rates by that operation, by forcing the RRPs back into the market. I think that the conventional wisdom is that the Fed, quote unquote, sets rates. But, for them to actually make something happen, they would have to lower the reverse repo rate below the rate of T-bills. And then that would be another way of forcing money into the market and lowering money market rates. But as long as you have the supply and demand at work in the T-bill market, that's where your rates are really set in the market for 4-week and 13-week Treasury bills mostly. So you can see that's where the market is working, and you can see that the Fed is just basically every 6 weeks catching up with where the market already is. The Fed has never on its own raised rates or lower rates. It merely catches up with what the supply and demand of funding is doing in the T-bill market.
So is there anything more to understand there about the reverse repo market and how it works?
As I said, it's really a fund that the Fed set up for the money market funds so that they're not sitting with cash in banks without earning any interest, because that would create a problem in and of itself for these funds. And it's all a crony system. The companies that run these funds are cronies with the guys that run the Fed. So they're basically just scratching each other's back. The Fed created this program so that these guys wouldn't go bust and be homeless on the street, sleeping on a steam vent, in lower Manhattan. So that's the way it works. They scratch each other's backs, they take care of each other, and that's how the system is structured, and that's what it's for. And all the other ruminations that people post about the RRPs meaning this and that and the other thing, I just don't believe in any of that.
Mm-hmm. You also mentioned the debt ceiling and the debate that is coming with that. Do you think that there is anything important to understand about that, or is this just business as usual again?
Well, of course, it's business as usual. But the imposition of the debt ceiling normally would limit the issuance of new debt to the public. And under those conditions, the limitation of supply would be very bullish. So when the debt ceiling is imposed, that's usually a bullish influence. But the creative rocket scientists at the Treasury, in conjunction with their cohorts at the Treasury Borrowing Advisory Committee, which is a committee of the leaders of the biggest banks and institutions and primary dealers in the world. Again, they're all cronies. They all get together and they found a way to continue to issue debt to the public at a very constant rate. So they're still issuing coupon debt at the levels that they suggested they would, 100 billion or so a month. And they're doing that by there's another aspect of the debt that's subject to the limit, and that is what they call intra-governmental debt. And that's the debt that the federal government owes to its internal funds like the Social Security Trust Fund, government pension funds, and so on. So what it can do, it can continue borrowing money from the public through public debt sales and paying down those future IOUs. So that's what it has been doing in order to keep this supply of debt flowing into the markets. So they've kind of kept things stable that way. However, they are going to run out of cash at some point. They're down to 170 billion now, and they were up at 600 billion before the debt ceiling was imposed. And when they get down to around 50 cents, they're going to have to do something. And the experts at that are saying that it's going to happen in July and August. And I have no reason to quibble with that. I think that's a pretty strong likelihood. It might happen a little before that. And when they lift the debt ceiling, then the Treasury is going to have to repay, all the Peters that it borrowed from to pay back. And then they're going to have to do that by selling a hell of a lot of debt into the market over the course of a month or two. And that's going to be a crushing burden for the markets come late summer or early fall of this year. So, that'll be the time, maybe this summer we should think about turning bearish again, or at least after this initial April tax windfall is all deployed into the market in through April and May. After May, we'll have to see how it plays out on the stock charts.
Bob, do you have anything you'd like to ask Lee about, or anything to add there?
No, I can tell everybody one thing. I mean, Lee's been excellent at calling this market really week by week, and using his experience to really see what's actually happening, not just with the stock market, but the system in general, and then how that interacts with the liquidity of the markets. And ultimately, when you talk about confidence and the trading aspect of the market and how people react to different things, this liquidity has an enormous impact because it's a chain reaction type of event. So, as money dries up, Lee has been absolutely on top of the bank's balance sheets. I mean, he's been calling this, a year and a half ago, especially when QT started, that this was the ultimate effect. And I think it's one thing to mention too that the bank term lending or bank term funding program, BTFP, I guess, is
I call it the BTFD. Buy the effing dip.
Yeah, it's one of those things that's also stabilized the Treasury market, because it allowed these banks to borrow from the Fed at 100 cents on the dollar for what their basically assets are worth, maybe 80 cents on the dollar. So it's arrested sort of that run per se, or at least the damage on the balance sheets for a temporary period of time. The big question is, and Lee's mentioned this, is that as interest rates have risen, people like you and I or whatever go out and buy T-bills because we're sick of the 0.3% we're earning on the savings account. And so that's creating another tertiary issue that the Fed may not have recognized. It's fine when the primary dealers and the cronies get paid 4.5%, with the reverse repurchase program. They don't have to go into taking any risk with commercial paper and all that garbage. They just go right to the Fed and they get paid out, and it's guaranteed, and it's full liquidity, 100% on demand anytime. But when we do it, it's like, wait a second, we got to put the brakes on everything, and everything's falling apart. So it is a big confidence game. And you see that in the metals markets. You see the public waking up and saying, listen, I don't know where to go with my money, but a haircut at the bank doesn't sound that terrific. And earning literally nothing on my savings account doesn't prepare me for that risk as an unsecured creditor. So, why not look at either T-bills or government money markets? Or, hey, listen, if the Fed has to come to the rescue and they just expand their balance sheet by $400 billion, well, what about gold? What about something that's going to maintain my purchasing power? Because ultimately,
or Bitcoin, God forbid.
Yeah. But and that's where the I think this velocity of money can start picking up, especially if the money supply isn't really picking up, so to speak, and bank deposits are coming down and money's it's going into money heaven, so to speak. That could lend to velocity picking up. And oddly enough, inflation, or some say hyperinflation, but high inflation rates tend to correlate with high unemployment rates, not low unemployment rates. So the what we're seeing here recently with the Fed saying, listen, we're going to keep raising rates because the employment picture is so grand, and we have wage pressures and service pressures still in the system. Well, they're sitting there raising rates into a slowdown that's already started happening, and you see it with the supply management numbers and this morning's private payroll number and so forth. Things are starting to crack, and they're like, it's like raising rates in front of a train crash. And ultimately they're going to be forced at some point. That's the feeling amongst investors, is that they're going to have to come back to the market at some point and bend the knee. And at that point, what happens with inflation? And this is the problem when you kick the can down the road for 25 years, ever since, some say, long-term capital management, 98, or, maybe the NASDAQ, that type of thing. Or you could go way back to the 1987 crash, and what Greenspan instituted was sort of a policy of sort of managing money supply and kind of guiding the markets. But this is the culmination of all that. And for what precious metal investors have been looking at, that have owned it since the beginning of time, you buy the metals when there's uncertainty, when there's political instability, when you have uncertain outlooks geopolitically. Confidence is everything, and this is the concern that I've been telling people is, everyone gets caught up on the day-to-day action with the COMEX futures markets and the whippiness of the paper markets, but the long-term holders say, listen, I don't know what's going to happen 2 years from now, let alone the election, let alone, if there's going to be a banking crisis, maybe later this year, especially with what Lee has mentioned with regard to, when this, the debt limit ceiling gets lifted. I mean, I would think the Fed's going to probably, and Lee's probably right on the mark, they're going to try and reduce the repurchase program, try and get that money back into supporting maybe T-bills and sort of that flood of supply. That would be the chess moves, I guess you could do. But ultimately, it's this idea that the Fed's raising rates right now while the market rates are coming down. It is like running around with your hair on fire. It doesn't make any sense how they're raising rates, and you got the 2-year Treasury now that's below the 13-week bill. I mean, and the last time that happened was 2007, right in front of a major disaster.
Well, the Fed says it's going to continue raising rates, but ultimately it'll do what the market tells it to do. It's not going to go in the opposite direction of the T-bill rates. It would look ridiculous. They would lose. I mean, if they haven't lost all confidence already, I mean, that would be the piece de resistance for that. And I think they'll just follow the market. So basically, I just keep an eye on the 13-week bill rate, and that's kind of like the thermometer or the barometer that tells you how much pressure there is in the money market and whether there's more liquidity flowing in than flowing out, and vice versa. If you watch that rate, that'll pretty much tell you what the Fed's going to do. They just track that like clockwork. Every 6 weeks they catch up, and the markets are always way ahead of the Fed. Way ahead of the Fed. It's just such a joke to me that it's entirely accepted Wall Street religion, conventional wisdom, that the Fed sets rates and everybody's waiting, and that the Fed tightens by setting rates. It's not true at all. The Fed tightens by removing liquidity from the system, and then the market adjusts, the money market adjusts to that by setting rates, and then the Fed plays this make-believe game that it's setting rates, but it's not. It's just rubber stamping what has already happened. So keep an eye on that 13-week bill. That'll tell you, and it's interesting. I want to see what it's doing right now. It's kind of stabilized up here lately. Yeah, it's 483 or so. It's kind of been in the same range for the last month. It had a wild fluctuation when we had the bank runs, and then you saw the 13-week bill rate drop by 60 basis points, but it popped right back up again because that was abnormal. So right now, it doesn't look like much of anything's going to happen at the next Fed meeting. They're probably, they're going to make an excuse to stand pat, not raise rates. They always have ready excuses. This is what the Fed does the best. is make excuses, self-exculpation. That's the Fed's game. Ben Bernanke is a genius at that. Shifting blame, these guys shifting blame all the time. And then the market turns around and blames, okay, we're getting into my pet peeves now. But Wall Street and all the pundits and all my friends are blaming Janet Yellen. Okay, she's the only one that did the right thing. She's the only one that shrank the balance sheet. There was no inflation when she shrank the balance sheet. Okay, and now everybody's blaming her. I think it's sexism, to tell you the truth, because Powell and Bernanke are the real villains in this game, not Janet Yellen. I'll defend her, till my last breath, because she did the right thing. She shrank the balance sheet. Powell came in, he panicked, he reversed everything. He doubled down again and again with this insane QE. And now we have 9% inflation. It's really 13% inflation. We have sticky consumer price inflation, like asset prices, housing prices, commercial real estate is a disaster. Everything is so distorted because the Fed messed everything up with this 12 years of insane money printing. And Yellen is the only Fed chair that tried to do the right thing, and in fact did do the right thing. And when she left, they were doing the right thing. And Powell came in and he panicked and he took care of all his cronies and he reversed the policy. And we saw QE to the moon and these enormous distortions that we have today. But it's good for gold.
Nice little way to conclude that.
I think it's important too. Yellen, she's a banker as well. I mean, she's using the U.S. Treasury.
She's a labor economist.
Labor economist, but she's using the U.S. Treasury. She's a smart lady. I mean, she's using the U.S. Treasury as sort of a monetary policy extension by doing these bills.
This is not new. This is the way it has always worked. But of course, and she's got rocket scientists working for her at the next level down that are always there, and they're really good at threading the needle in crises. As you said, kicking the can down the road. Yes, I agree. Sorry for interrupting, but
Oh yeah, but it's this idea that there has to be management or interaction now at every point in this whole system. It's so leveraged. The numbers are so big that they cannot allow anything to build any head of steam, because it's like a tsunami. I mean, when that banking crisis happened, the water went right out into the middle of the ocean, and you knew it was going to come back. The problem was going to come back in spades. And they got to try to arrest this thing before it really builds up steam. The problem you run into is that it's been so much money creation, and 80% of all the cash printed by the U.S. sits outside the country anyway. The worry is that when confidence around the world starts to drop on the dollar, maybe they don't need to use the dollar as much for a form of trade. They do more country to country exchanges rather than using the dollars in intermediary exchange. When those dollars come back to us, that's when inflation is really going to run rampant. And that's, I think, the biggest concern is that to stave off a complete banking crisis, they're going to print money, whether it's the FDIC paying everybody out and making everybody whole, or they can't
possibly cover all the potential losses. It's a drop in the bucket.
Yeah, I think you mentioned, the first couple of guys, get the best payout, but then, once if it does start to really run downhill, you're right, they can't cover everything. Otherwise, you're just going to crack the dollar at some point, and they're going to say, what's this monopoly money worth?
Is that because if the Fed and the Treasury step in again to back those deposits, let's say more than that $250,000, that just becomes very inflationary or devaluing for the currency?
Well, it's a call on the U.S. taxpayer, and the question becomes in the currency markets, who's got the cleanest shirt in the laundry? The European banking system is no better off than the U.S. banking system. What about in Japan? I don't know how their banks are doing, but those are the three big, the three big central bank cohorts that are managing all this. And the dollar looks weak right now. If you look at currency rates, the dollar against the euro, against the yen, over long periods of time, and you compare that with the relative monetary policy of each of the central banks, there's a pretty strong correlation. So it's a question of who's easier, who's tighter, who's printing more money, who's printing less money. So, the Fed just printed a hell of a lot of money in the last couple of weeks. And I said it didn't go into the markets necessarily, but there's more dollars there. So yeah, the dollar's been weak, and it doesn't look good. I'm sitting here in Europe, in France, and I'm earning my income in dollars. And I was in Clover for a couple of years there because the euro was crashing against the dollar. Now it's going the other way, and it looks to me, it's around $1.10 now. It looks like it's going to $1.20 if you look at the charts. So yeah, the dollar is going to be weak, but is there going to be a long-term loss of confidence in the dollar? Well, maybe, but relative to what? Who's any better? Where are people going to go? And then that comes back to the yellow stuff. Well, at the margin, people are going to want to hold the metal. I think. I think it's good for gold, and I'm not a gold bug. I've never been, but now I see the rationale for it. I see it very, very clearly. And I love the charts. I'm a chartist, so I like what I see.
Yeah, and I think it's a natural evolution that the central banks were buying so much gold last year, and even in the first quarter, we're just the public sees that, and that's again a confidence play. The central banks may not move the gold price per se because they don't go onto the open market right onto the futures exchange and buy and hold for delivery and take delivery of the product. They buy through back channels, through the refiners, through bullion banks, and it's all OTC types.
Buy out of the market, though, right, Bob?
Yeah, but more importantly, it adds confidence. It's guys like me say, well, listen, if X central banks are buying X amount of tonnage, they see something that obviously we don't. There's a reason why they're doing this. It's just like watching the stock market, and the primary dealers taking an inventory, marking it up, and selling to the public. Is they know that they got money flows coming in, and so it's a similar concept. So you're just trying to not get into the esoteric stuff of is the world going to end? Is the dollar going to go to zero? No, the currencies aren't going to go to zero. If it did, I always tell clients lead would be exchanged at its fair market value, but the issue I think we're running into right now is commodities are being revalued, I think, or maybe being relooked at as a currency in and of itself for a store of value. And I think that's a lot of people that do the energy markets and look at energy, they look at gold and silver as a store of value or a store of energy value, not necessarily a store of wealth, so to speak, paper wise, because it takes energy obviously to make this stuff. That's the way I think the physical, at least that's how I try to educate people how to look at the physical market, because it's a little bit, it's you don't get caught in the ebbs and flows of the ups and downs of price action and that type of thing. You're really looking at the long-term picture, and I think more high net worth investors, especially ones that have excess 250,000 in cash in the bank, they're now saying, listen, you have the 2017 Trump Tax Act. You're going to have the sunset provisions start to take effect in 2025, where all the income rates that were lowered are going to come right back up if they decide not to renew that. You have at the same time, an economy that slows is going to be less tax revenue. This whole game is partly about making sure tax revenue doesn't fall through the floor, because you're going to have municipalities that are relying on higher tax revenue bases from the increase in real estate prices and that type of thing. If real estate falls, their tax revenue base falls. It has this thing has a doom loop effect that once it starts, it ultimately it can be a wrecking ball. And the only way to cure that, or I shouldn't say cure, but delay it, is basically printing money and trying to lower the value of the currency, which may inflate the prices of assets or maintain the level of assets. But in reality, what happens is your cost of living goes up, and we all feel the effects of it. And this is all saying that we don't have any type of food shortage issue or bad farming season, that type of thing. I mean, everything is predicated on a perfect scenario. I mean, look at Europe this past winter, had a very mild winter, and energy prices didn't go through the roof, and things were okay. But is it going to be like that next year? I don't know. But you're almost expecting to have a perfect outcome at every turn to make sure this whole market stays on track.
Yeah. The one thing I think that this has been the most widely anticipated and most widely forecast recession since Dewey defeated Truman. So the end of month for March daily Treasury statement is out. I have not, because of the renovation I've been going through, I haven't had a chance to run those numbers yet, but I'm going to try to publish that tomorrow. And I really want to see where the withholding taxes are, because, is this economy really softening to that extent? I don't know. It's what I hear all the time, this statistic, but the tax data will tell us, and I'll get that posted in a day or two over at Liquidity Trader. And we'll see whether the economy is really contracting, because you're right. If the economy contracts, there's going to be less tax revenue, and the whole problem is going to get much worse, because the Treasury is going to have to borrow more money in the market, issue more supply, put more pressure on asset prices. So, but so far the economy has been incredibly resilient, because the deficit spending is economically bullish, and we have huge deficit spending month after month, and we continue to fund it. And if this bank run situation becomes self-correcting via the mechanism of rising bond prices and falling yields, we could actually find our way out of this magically. So there's a lot of moving parts. Of the worst case scenario would be my favorite scenario, but there still is possibility that if we get a huge rally in the bond market, then it may be because the Fed forces the RRPs back into the market. Maybe the Fed decides that there's so much risk in the financial system that it has to foster the lowering of interest rates, and consumer inflation be damned. Well, at that point, we might see things turn out pretty well. And I'm not saying that that's going to happen. It's a possibility, but we don't need to anticipate. As investors, all we need to do is follow the money. Just see where the levels of deposits are going, and we're in the part of the 4-year cycle that should be bullish. We should be in a rip-roaring bull market at this stage. It should have began last October, but instead we're kind of waffling around. But and I don't know what causes the 4-year cycle, 3-year cycle. Is it a psychological thing? It's been going on for a long time, and we're in that stage of the wave where it should be positive. So you have to look at the potential that for the next year to 24 months, things might look okay, that the dominoes will fall in the right direction rather than the wrong direction. So I don't want to be overly pessimistic, but I do want to follow the charts and follow my, I always say, don't fight the Fed. Well, we don't know what the Fed's going to do, so we can't not fight the Fed. What we have to do is discipline ourselves to simply keep track of the barometers of money and see how they are trending. And they're still trending lower. Now, until that changes, we have to feel like, these rallies in stocks and bonds are going to be limited. They're not going to go on forever. And there will be trading opportunities on the short side, whether it be in stocks, or if you want to short fixed income, God bless you. But, but the chart that I really like now is, as I said, is as gold tests that 2080 top. And if it hangs around up there for a few months, it's going to blast off again, make a nice cup and handle, or it may just go right through this time. So that's another thing. I really want to watch that chart, because it has a conventional and measured move objective of, if it breaks out of 2080, it's probably going to 2400, 2450, 2500. And that's, and that's a short-term thing, 6 months to a year out. I think it's not something you have to wait 5 years for.
You look at gold based on cycles. What are some of the different time periods that you're looking at with that?
Gold it's so manipulated. I've never really been able to isolate a workable, tradable cycle on it. It's a long-term thing. I mean, the last top was in 2011, and then it continued to. Was that when the top was? 2000? I don't have the chart open in front of me.
Yeah.
But the downside lasted how long?
About 9 years. 9 years. 2020.
Yeah, so we bottomed 2 years ago. So we've been in a bull market already for 2 years, and maybe it'll last another 10 or 11 years. So if I think That's always a possibility. But again, a lot of it is going to depend on this banking situation. Every time a bank run flares up, I think you can probably count on a 10% up move in gold. So we'll see if there's going to be another bank run and how much that stimulates interest in precious metals.
Yeah, the other thing too to take into account is part of the stimulus packages that we did the last couple of years. They put moratoriums on paying rent, paying mortgages, paying car loans, all those types of things that benefited the consumer, and they went out and spent that money or bought crypto or traded the stock market, whatever they did with it. But those moratoriums are now ending, and that's going to be another. You have to pay your tab at this point, and the consumer credit balances, the loans on these is enormous. I mean, they're all near all-time highs or at all-time highs. So that's going to be where again, they can't afford a recession or a real downtick in employment, because that would have a widespread effect on a lot of asset-backed loans and purchases. And that's why I've said, the banking crisis, the next evolution of it is the impairment or write-downs of a lot of these asset-backed pieces of paper, the car loans or the, whatever that the bank owns, the commercial real estate, which Lee.
Commercial real estate, you forget about it. That's just, and I've been through that with boots on the ground 30 years ago. So I've seen that firsthand, and that's a catastrophe. It really is. And then there's the whole issue of the value, the market value of the government bond market. All of these bond holdings are underwater, and not everybody is in a hold to maturity situation. The banks own trillions of this stuff, and they may say they're hold to maturity, but every time there's a bank run, they got to sell. So there's a tremendous amount of hidden loss out there that we haven't come to grips with yet. And like I said, maybe they can thread the needle, but a lot of stuff can go wrong. And I don't deign to predict whether it will or whether it won't, but I'm ready to go short again, but I'm not ready to do it yet. But when the time comes, when we start seeing technical signals that these rallies are running out of gas, well, you got to kind of dip your toe in the water on the short side, like I did in the middle of March with the golds, with the junior gold stocks. I said, well, I see some really embers of a little flame here, so it's time to dip because we never know when the really big turn is going to be. So you got to start dipping your toes in the water and taking small amounts of risk. And then if the trend really turns in your direction and it's going to be persistent, then you can continue to build positions on the way up. That's how the pros do it. They average up. They don't average down. So unless you're a true vulture and you have the vision to see the absolute bottom of the market, but not many people can do that.
So do you think, Lee, that the next biggest risk that you can see at this point is more turmoil in the banking system?
I think so. Yeah. And there's a lot of potential triggers, the commercial real estate in particular, which, I happen to have a little experience with for 15 years. And that could be an ember that catches fire. Who knows what is going to. It's the big guys. In Philly, we call them the big mahafs. They're the ones that are going to panic. The institutional guys, mom and pop, they're covered. They feel secure with their mom and pop trader, feel secure with their FDIC insured savings. So it's what the big shots are going to be worried about. What are they going to see next? Where are they going to panic and pull their money out of a bank overnight and trigger another massive crisis? And we know that there are still trillions of losses buried out there. And we don't know how long they'll stay papered over. We had this paroxysm of fear and loathing hit the market all at once. And then everybody kind of exhaled because the Fed came to the rescue. And things are going to be quiet for a little while now. But where is the next crisis? I don't know. We just have to see what happens and see what the Fed's reaction is. But ultimately, there is going to be another crash in the stock market, another big bear trade coming. But I don't see it in the charts yet. And in the end, we have to rely on technical analysis. And hopefully, it'll give us a sign, if not right at the bottom soon or the top soon enough after, that we can take that nice chunk out of the middle, whether it be on the short side or long gold. That's what we need to do. We need to get that chunk out of the middle. I'm not going to call the absolute top the absolute bottom, but I want to see the long-term indicators that I track on the technical charts. I want to see them begin to reverse to the downside. And in the last few months, they've been kind of trying to go up. The way I see it, we're probably going to trade in a broad range for a while, like we've been doing in the last year in stocks, and then in a year or two, maybe break down out of that range and have something really terrible happen.
Is there a way, Lee, that, as you look at liquidity flows, is there a way to track that for gold, as you said, to, let's say, confirm that sustained move once it gets underway?
I think the bottom line for gold is to look at the long-term, the monthly and the weekly charts with a variety of long-term technical indicators. There was just a classic high base pattern that was developed over the last couple of years with a beautiful saucer pattern that everybody turned bearish as hell on gold, and gold was a beanie baby type of thing, or I forget what this guy in the Wall Street Journal called it, or the
Pet rock.
Pet rock, yeah, pet rock, yeah. He nailed the bottom, didn't he?
Yes, by one day. One day.
The pet rock column nailed the bottom. So maybe that's the best indicator. Look for somebody who either calls for gold as a pet rock again, or basically says that gold is the only insurance policy, and gold is on the cover of Business Week, and everybody's touting gold again. We are a long way away from that. So.
Well, it's funny because I posted. Mark Cuban came out, I think it was in December or January, did an interview and said, if you own gold, you're a fucking idiot.
Well, that's another sign of the bottom. Yeah.
Right. Yeah. So yeah.
TV moguls.
Yep.
I was going to say, it reminds me of that Newsweek cover with the dead dinosaur that says inflation is dead, and that pretty much nailed the bottom in
bottom of that. Yeah. It's uncanny. It's uncanny the way the media and reporters can nail these highs and lows with regularity and throughout history. So I'll never forget the pet rock thing. That's right.
It's important to note that if we're at 2,500 gold, there's a reason why we're there too. It's not just because it's trading Tesla stock and everyone's giddy and and just barging up and just loading the boat and pushing the shorts higher. There's something that's going on out there. Gold is really a fear, or a barometer of fear out there. And this is a global story. This is, just like Lee mentioned, this is a European story. This is an Asian story. The commercial real estate market, you saw it was at November last year, where BlackRock and another large REIT shut down withdrawals because their market to market of the value of their portfolio was a lot different than the reality. And then of course, when the auditors came in February and started going through the books, they're like, wait a second, this doesn't make any sense. And that's where you started to see these write downs or these impairments or defaults on, was it $1.5 billion in real estate in Los Angeles. This is the stuff that when everything starts to roll over, it tends to roll over right at once, it seems like, and they just throw everything right off the cliff together. But the problem is, as an investor, at that point, it's too late to react. And this day and age, with these bank runs, it's not a matter of standing in line. You just got to be online, and you can do a bank run. That's what's really scary. Is
that's what happened exactly? It was an instantaneous event that happened in a matter of minutes, and the next time we are really in uncharted waters here. So like I said, I'm not going to try to predict what the next domino to fall is going to be. We can speculate about it, but I think about commercial real estate a lot because I spent a lot of years. I spent 15 years evaluating as a commercial real estate appraiser in Florida. I went through that crash in the late 80s and through 1992. And I ended up doing a tremendous amount of recovery work for the RTC and the FDIC because I was one of the few appraisers that was willing to kill deals before. And everybody hated me. But in the end, when the market collapsed, the government agencies that were the only ones buying appraisals came back to me because I had given them the correct information in the first place. So I just wanted to say that many of the properties that I appraised ended up selling for, and I reappraised them for as little as 25 or 30 cents on the dollar. So if you consider the trillions of commercial real estate loans on particularly office buildings, because we know the societal change, cultural change that's taken place as far as people not needing to be in the office anymore. Huge, huge, huge losses that have not been recognized in the commercial mortgage sector. But even those huge losses probably pale in comparison to the losses in the bond portfolios. So they really need a self-mitigating crisis where the whole world decides that it wants to buy treasuries because things are so bad and it's so scary that maybe they'll buy some gold, but they really want to buy treasuries because that's the only thing they have confidence in. And if they drive the treasuries, if they drive the prices up and the yields back down into the twos, it's possible that this could be a self-correcting crisis. So, but there's going to be a hell of a lot of pain. You know, if they drive treasury yields into the twos and bond, that means the prices are going up, 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 up. It means they got to be selling something. And what they're most likely going to be selling is stocks. So I think we'll see a traditional situation where, you know, bond prices are going up and stock prices are going down. And that's one prediction that I'll kind of say that's sort of in the corner of my mind in the future.
Yeah, and to add to your point earlier, Bob, you know, this idea that there are all of these issues that kind of coalesce at the same time. You brought up the idea that there are the moratoriums ending and consumer debt is at all-time highs. And as Danielle DiMartino Booth keeps pointing out on Twitter, there are thousands of layoffs happening over and over, you know, week by week. It's just constant, it seems like. But yet that doesn't really seem to be picked up in the, let's say, the lagging employment data that we see out of the Fed.
Yeah, and some of this stuff, I mean, last year when people are getting signing bonuses to work in fast food, you know you're near a top in the employment picture. I mean, it doesn't get much better than that. And that's potentially what could have been helping, you know, the wage pressure and all that was just, hey, listen, I'm going to jump ship to, you know, I just got hired here, but now I can make a signing bonus and make another 50 cents or $2 extra an hour working there. And they just jump ship and move on. But that's usually where you see a top of an employment market. That's, you know, it's like it's a sort of I guess a seller's market, so to speak. Now that that's kind of stopped, you know, the markets always revert back to the mean, and whatever happened last year is usually going to be the opposite the next year in a way. I mean, things don't stay the same all the time. That's what I worry about, because the concern with, for example, commercial real estate, for example, you know, these institutions, you know, we've lived in this world of passive investing, or this passive craze of indexing and 60-40 portfolio, and, you know, BlackRock, you know, trillions of dollars wrapped up in all these structured programs and products and ETFs. What happens if the public just says, you know what, I need cash now. I'm getting nervous on the market, and that passive craze starts to reverse, not a lot. It just reverses a little bit. Who's going to buy this stuff? I mean, that's the problem that you have, is when things start moving the other direction, it's a rate of change, I guess you could say. It could have an enormous impact, even though it doesn't move the needle much, just because the lack of liquidity that could fall out from this whole thing. If the Fed says, you know what, we're going to keep rates tight because we're going to fight inflation, and all of a sudden the fires start to, you know, it goes from an ember into a blaze instantaneously, and you know, I don't know how you deal with that. I mean, in real time, in an online market, especially now that you have AI. I mean, these I mean, it's scary. I mean, you can pass the bar exam, with Chat GPT or whatever. I mean, it's not not your father's market.
So, Bob, the points you raise, I just want to double back to. I mean, really, all we can do is follow the data closely, see what the trends are doing, and all of this anecdotal stuff about layoffs. We have real data on how many people are working, and that's the daily withholding taxes. So all of this guesswork that's going on about what's going on in the jobs market, we don't have to guess.
Okay.
Tomorrow I'll publish the end of month data for March, and we'll know how the employment market did. Forget about the BLS and all these anecdotal reports of layoffs. I mean, it's story time. The reality is the tax collections. They don't lie. They're not manipulated. They are what they are. And we can compare them year to year. And the rate of change in the year-to-year comparison will tell us exactly whether the job market is continuing to expand or it's slowing down. So all that other stuff, it's just a bunch of diversionary stuff that Wall Street uses to keep people hooked on the market and hooked on the idea that only Wall Street knows and can manage your money. It's not true.
Well, guys, I think that's a good place to wrap up for today, unless either of you have anything else to add.
Well, I would mention with Lee's reports, he's really a diamond in the rough. It's worth for investors out there that are trying to get sort of the plumbing on the system, how things actually interact with the market and liquidity. He really spells it out really well with his newsletter service. It does a great job. I mean, this is a very complicated subject, and there's a lot of data that you can really get lost in the weeds with. He really has taken the time to parse it all out and interpolate it, I guess, in terms of making it easier to understand, and then not only making it easier to understand, but how it reacts with your portfolio. What to kind of expect, and it's been a godsend. I mean, it really is worth the time to take a look at his pieces, especially his liquidity reports, which are just fabulous. I mean, he's noticed things like, especially when the Fed, like you mentioned, the Fed cuts out some type of data that they don't want to show anymore. There's a reason why they do it. It's not because they don't have enough resources to parse out that data. There's correlations there as well. So it's worth it.
Years ago when they stopped publishing M3?
Yes. You can't make this stuff up. I mean, it's just yeah. And you're right. The CPI numbers, all that stuff is just complete hoax. It's designed to manipulate, the public as well as expectations and confidence. That's what this whole thing's about at the end of the day. And that's why when gold's rising, for me, it's a fear indicator from a standpoint of confidence that more and more people are sort of saying, this stuff doesn't make any sense anymore. I just can't make 2 and 2 add 4 anymore. And I think that's the reality of owning physical metal. For me, it's a long-term game. It's not just buying and selling, on the price action from month to month or year to year. It's a long-term picture. So,
well, Bob, since I live in Europe, can I store gold at your Idaho armored vaults?
Yep, we have clients all over the world.
If the shit hits the fan, how will you get it to me? Will you fly it over? Or what?
We'll send it by carrier pigeon.
Yeah.
But yeah, it's funny because we have a lot of clients around the world because Idaho doesn't have any sales or usage tax. In Europe, especially if you buy silver, there's a VAT. And in Europe, certain areas, gold as well, or it makes it more difficult to get gold, for that matter. So you want to obviously own metals in a politically safe jurisdiction, and that includes taxation policies, things like that, as well as privacy issues, reporting issues, how much information you have to give to a custodian. And then, of course, what we've seen here recently with First State Depository going under, that bankruptcy now and fraud is now, it was 40 million. Now the estimates are up to $58 million of worth of assets that were basically not accounted for at this point, vanished or gone, and it's going to be the largest depository loss in history. I mean, it's huge, and you're seeing with crypto as well. These exchanges and billions of dollars of losses. You really have to understand your counterparty. We're looking at systemic and counterparty risk as the two main risks, and this idea of return on your money. You really have to be now in an environment of return of your money. I think is more important, especially with regard to inflation and the potential purchasing power. If the Fed wants to kick into gear and start to potentially increase the balance sheet, or another bank flare up happens and forces them to increase the balance sheet. So, and this is the dichotomy that a lot of investors are trying to weigh through and try to understand the landscape. And Lee does a great job explaining all this and giving people sort of a play-by-play synopsis of how things are transpiring and how they're actually going to play out. And it's amazing. He keeps it simple, and simple is better. I grew up in the idea, if you can't write the idea on the back of a business card, it's not worth investing in. Monetary policy is the same way. Don't do what they're saying, do what they're doing, or look at what they're doing. And he does a great job of trying to filter, the political side of it and sort of the principle side of it to actually, hey, what are they actually doing? And it greatly helps. It provides a lot more certainty, at least for the investor, and it gives them a better understanding of what's actually happening.
Thank you very much, sir. Appreciate the kind words.
Sure.
Well, perfect. That's, of course, available at liquiditytrader.com, your Wall Street Examiner at wallstreetexaminer.com. And what would you call that, Lee? Your political commentary at Capital Stool?
Well, just real briefly, 20-some years ago, I decided to have a little fun with Wall Street. I started this message board that was kind of based on a theme of toilet humor and Wall Street. And I called it capitalstool.com, which was a takeoff on the Forbes slogan of the capitalist tool. I just dropped the I and turned it to Capital Stool. So we had a pretty thriving community there years ago. Now it's just a few of us, and Bob is one of those people. And we have a good time every day. We chat about the market, just in a very short-term microcosm of what's going on in that particular day. So we would welcome more joiners and members of the board. And we have a great time discussing the business of the day.
Perfect. And of course, you're available on Twitter as well at Lee_Adler, ADLER. And of course, everybody knows Bob, but he's available at goldsilvervault.com and at Profits Plus ID on Twitter. Gentlemen, thank you so much for your time today. Really appreciate the joint discussion here to really flesh out a lot of these ideas.
Thank you, Tom.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.